All right, folks, second trading session of the year. And for some reason, the share price continued to plummet. All right. As you can see, the price is down 5.4% at the time of recording this video. And at some point, it went all the way down to the 2460. So is there another attempt from the short sellers to actually put this down? Possible, because when you look at GameStop, also, GameStop is kind of following the same path. They are pretty identical. But I want to share with you in this video some news, that is actually pointing out to the fact that, hey, you should not pay attention to this price because this price is entirely fake. This is fabricated. I mean, look at this. The hedge funds business is struggling to learn new money as performance lags. Well, it doesn't surprise me. Does it surprise you? No, it doesn't surprise me at all because the hedge fund business was not supposed to do what they're doing now. And inflows into hedge funds have in turn proved meager with performance concerns, adding to investor questions about returns and fees. Look at what this guy is saying. Ghali, managing partner at Sussex Partners, which advises clients on hedge funds investments, said there had been a huge dispersion in hedge fund performance in 2021. Huge dispersion. A fund betting on the company's falling share price might correctly predict a poor set of earnings, but then you might get your face ripped off if retail traders come into the stock. He already learned the lesson, so he knows better. Hedge funds have suffered a slow exodus of clients in recent years, with investors more often drawn to the higher returns supposedly on offer in private equity and private debt funds. Here's the thing, folks. When you look at the performance of the hedge funds in 2021, we're talking about an 8%, all right? 8% is what they were able to pull from the market in terms of performance. But keep in mind that when you take your money and you give to a hedge fund to manage, you are expecting more, way more than just 8%. Because as a matter of fact, the S&P 500 alone had a 40% return so far this year. So far last year. At 24% as of November. So this is actually triple the performance that hedge funds were able to pull from what they were doing. So if I'm a client, do you think I'm going to still, have the decency or be driven into giving my money to the hedge funds to manage, especially with 2021 being so, I will say, easy? If you just thrown your money into an S&P 500 index fund, you would have tripled the money if you gave this to hedge fund managers. So with 2022 being even a more trickier year to find what we call the alpha, to find that performance, to find those gains, what do you think is going to happen for those clients that are now looking to remove the money from the hedge funds? And I guess that's why, those hedge funds are not preventing them from actually withdrawing that money because it's going to sink them to bankruptcy. All right? So hedge funds have been hit by a series of market jolts, including the GameStop frenzy. And by GameStop frenzy, they actually mean the meme stock frenzy, which includes AMC. Sharp moves in bond yields and a clamp down on China's education industry, plus China's property market as lately. Managers have also complained that stocks have failed to react to earnings news in the way they have in previous years. Well, yes and no. But the reality is some hedge funds they did good. Some did decent, but some others, they are like, man, look at this. Some stock pickers have thrown in the towel. Intrinsic Value Investors, a $1.3 billion long-only company, told clients in autumn that it will return their money. Founding partner Adrian de Molven Otolu told the Financial Times that valuations are not attractive to make new investments. Hedge funds DSAM is also returning money to clients. If they are all returning money to clients and they are all looking and foreseeing, it's difficult for them to make gains. It's why? Because we were living in an environment where money was so cheap, so it was easier to take debt and margin and go and make those bets that may have worked in the past, but are not working anymore because retail traders are also an active investor in the market now. So the whole game picture has changed. So in order to finish this video, guys, what does it mean for AMC? Well, for AMC and for other highly shorted stocks out there in the market, it means simply this. The price you're seeing here, all right, same thing, the price you're seeing here, and these are just the two main examples. It really doesn't matter because it is just a matter of time. I mean, this article is pointing out the fact that hedge funds are struggling not only to find new money, but also to attract new investors. But on top of that, the existing investors cannot withdraw their money because they are not delivering the contract. They're not delivering the performance. So what do you think is going to happen next? Investors are going to start to flee, and then everybody's going to try to hedge against inflation, trying to find something that is going to protect their money because everybody's calling for a crash in 2022, even though that's not, I mean, we're still very early to see that, but reality is it doesn't look good for them. So as far as these prices go, it's just maybe a last attempt from them to actually try to give you and me, shareholders on AMC and GameStop and other highly shorted stocks, the impression that, hey, this might be the last days, you better sell now. But it's really them, actually trying finally something that would not work because we are here to stay.